Imagine walking into a supermarket where one product contains tiny portions of hundreds of investments. With one purchase, you could hold technology companies, banks, healthcare firms, government bonds, or even commodities. An exchange-traded fund, usually shortened to ETF, packages a basket like this into shares that trade throughout the day. Over the next 10 minutes, we will open that package, see how it works, and learn what to check before using it. An ETF is a legal investment fund and a tradable security at the same time. The fund owns assets according to a stated objective. Investors own shares of the fund rather than owning each underlying security directly in their brokerage account. The ETF wrapper explains how the investment is packaged and traded. It does not tell you whether the strategy itself is safe, diversified, cheap, or appropriate. The basket can contain many things. Equity ETFs may own company shares. Bond ETFs may hold government, municipal, or corporate debt. Other funds may obtain exposure to commodities, currencies, real estate, or a deliberately mixed portfolio. A prospectus and holdings report describe what the fund may own. The name on the label is only a starting point. The actual holdings are the source of most returns and risks. Several actors keep the structure running. A sponsor designs and manages the ETF. A custodian safeguards fund assets. An exchange lists the shares, and market makers quote prices. Another group, called authorized participants, can transact directly with the fund in large blocks known as creation units. Retail investors usually never interact with these institutions, but their activity helps connect the ETF share price to the value of the basket. Here is the creation process. When demand for an ETF rises, an authorized participant can deliver the required basket of securities, or sometimes cash, to the fund. In return, the fund issues a large block of new ETF shares. The participant can then sell those shares on the exchange. Redemption runs in reverse. ETF shares go back to the fund, and the participant receives securities or cash. Supply can expand or contract without the fund constantly trading for every retail order. This creates two related markets. In the secondary market, investors trade existing ETF shares with one another, just as they trade listed stocks. In the primary market, authorized participants create and redeem large blocks with the fund. Most daily activity happens in the secondary market. The primary market becomes especially important when price differences or strong demand make it worthwhile to adjust the number of shares outstanding. Every ETF has a net asset value, or NAV. In simplified form, take the market value of the fund's assets, subtract liabilities, and divide by shares outstanding. NAV is normally calculated at scheduled times, often after the market closes. The exchange price, however, moves continuously while trading is open. When the exchange price is above NAV, the ETF trades at a premium. When it is below NAV, it trades at a discount. Creation, redemption, and arbitrage usually encourage the trading price to stay near the basket's value. If ETF shares become expensive relative to the underlying assets, institutions may buy the basket, create ETF shares, and sell them. The reverse can happen when shares become unusually cheap. This mechanism is powerful, but not magical. During volatile markets, stale underlying prices, closed foreign markets, or weak liquidity can produce wider premiums, discounts, and spreads. Many ETFs are index funds. An index is a rules-based measurement of a market or segment. It chooses eligible securities and determines their weights. The ETF attempts to follow those rules, but it does not own the index itself. Some funds hold nearly every index constituent. Others use sampling. Fees, trading costs, taxes, cash balances, and imperfect replication can create a gap between the index return and the fund return, called tracking difference. Not every ETF is passive. Actively managed ETFs allow a portfolio team to select holdings instead of mechanically following an index. The manager may pursue income, growth, risk control, or another goal. Active decisions can add value or make results worse. When comparing an active ETF, examine the process, portfolio transparency, turnover, costs, and whether the manager's claimed advantage is understandable and repeatable. Diversification is one reason ETFs became popular. One broad fund can spread exposure across hundreds or thousands of issuers. That reduces the damage that one company can cause compared with holding only a few individual stocks. But a large number of holdings does not automatically mean broad diversification. A fund may still be dominated by one sector, country, currency, factor, or group of very large companies. Look through the wrapper to find the true concentrations. ETF liquidity has two layers. The first is visible trading in ETF shares, volume, market depth, and the bid-ask spread. The second is liquidity in the underlying basket. A newer ETF may show modest share volume while still holding very liquid securities that authorized participants can trade efficiently. Conversely, high reported ETF volume does not remove the risk of owning difficult-to-trade bonds or specialized assets during market stress. The bid is the highest price a buyer currently offers, and the ask is the lowest price a seller currently accepts. Their difference is the spread, an immediate trading cost. Spreads often widen near the market open, before major news, or when underlying markets are closed. A limit order lets you specify an acceptable price, while a market order prioritizes execution. Neither order type guarantees a good outcome in a fast or dislocated market. The expense ratio receives attention because it is easy to compare, but total cost is broader. Include the expense ratio, bid-ask spread, brokerage commissions if applicable, tracking difference, taxes, and any premium or discount paid when trading. A low-fee ETF can still be expensive for frequent trading if its spread is wide. A slightly higher fee fund can sometimes be more efficient when it tracks well and trades with strong liquidity. Equity ETFs range from total market funds to narrow slices such as small companies, dividend payers, or a single industry. Bond ETFs can focus on government debt, corporate credit, municipal bonds, inflation-linked securities, or particular maturity ranges. Bond prices react to interest rates, credit conditions, and duration. Two bond ETFs with similar yields can carry very different sensitivity to rate changes or defaults, so yield alone is never a complete comparison. Commodity ETFs require extra care because the structure can vary. Some hold physical assets such as gold. Others use futures contracts, which may produce returns affected by contract roll costs as well as spot prices. Sector and thematic ETFs can make a trend easy to access, but their stories may hide concentration, valuation, and timing risk. A compelling theme is not automatically a diversified portfolio or an attractive purchase price. Leveraged ETFs and inverse, sometimes called reverse leveraged, ETFs are specialized trading tools. A leveraged fund might target 2 times an index's daily return, written plus 2x. An inverse leveraged fund might target -2 times the daily return, rising about 2% when its benchmark falls 1% before fees. Both reset each day. Over several days, compounding and volatility mean the final result can differ greatly from simply multiplying the benchmark's total move. These products require close monitoring and a clear understanding of their daily objective. They are not simple long-term multipliers. The main risk of an ETF still comes from what it owns. Stock funds face market and company risk. Bond funds face interest rate and credit risk. International funds add currency, political, and market structure risk. Concentrated funds can fall sharply when one industry loses favor. Liquidity may deteriorate precisely when many holders want to exit. Diversification can spread particular risks, but it cannot prevent losses when an entire market declines. Additional structural details matter. Securities lending may generate income, but introduces operational and counterparty considerations. Derivative-based or synthetic exposure can depend on collateral and counterparties. Currency hedging can reduce exchange rate movement, but creates costs and may behave differently across periods. Fund size, closure policy, index changes, distributions, and local tax rules can also affect the investor experience. Tax treatment varies by jurisdiction, so personal advice should come from a qualified professional. ETFs can play different portfolio roles. A broad, low-cost fund may serve as a core holding. Smaller satellite positions may express a sector, factor, or tactical view. The right mix depends on goals, time horizon, ability to tolerate losses, and the other assets already owned. Rebalancing means periodically returning to a chosen allocation, not chasing whichever ETF recently performed best. A clear policy is usually more useful than a constantly changing list of exciting products. When comparing two ETFs, start with 6 questions. What exactly does each fund own? Which index or active process does it follow? How concentrated are the top holdings? What are the expense ratio, spread, and tracking difference? How liquid are both the shares and the underlying assets? Finally, What legal structure, currency exposure, distributions, and tax treatment apply? Compare funds serving the same purpose. A cheaper label is irrelevant if the exposures are different. Here is the final myth to clear up. Does ETF mean no risk? No. An ETF is a flexible wrapper, not a guarantee. Its advantages can include diversification, intraday trading, transparency, and access, while its risks come from the assets, strategy, costs, structure, and the price you pay. Remember the four-part summary. Inspect the basket, understand the mechanism, count the total cost, and match the fund to your plan. This explanation is educational and is not financial advice.